Welcome to Seven Bulls. We break down finance so that anyone can understand. Roll the intro. Hello, fellow investors. Welcome to Seven Bulls. Today, we're getting into two of the biggest players in the healthcare industry, HCA Healthcare and Universal Health Services. Both companies are well established and play a significant role in the U.S. healthcare system, so it's crucial to examine their financial strength, growth potential, and overall performance for investors considering a long-term hold in the sector. Before we move on, if you're enjoying this content, don't forget to like and share this video. It really helps us reach more people by boosting it in the algorithm. Also, you'll be helping others find our content just like you did. Your support means a lot. Thank you. Now, let's get to it. Let's start with HCA Healthcare. HCA operates over 180 hospitals and nearly 2,300 outpatient sites across the U.S. It has a massive footprint, serving millions of patients each year. One thing that stands out for HCA is its market cap of over 78 billion, positioning it as one of the largest healthcare providers in the country. But more than its size, it's important to note that HCA's forward price to earnings ratio is currently 12.7, which means the stock is relatively affordable when compared to its future earnings potential. HCA has also shown strong financial discipline by buying back shares, reducing its share count by over 5% in the past year, which is always a positive for shareholders as it increases the value of the remaining shares. The company's return on equity is off the charts at over 800%, which is an unusually high number. However, it's mostly driven by HCA's large amount of debt, with a debt to equity ratio above 80. That said, HCA is managing its debt well, maintaining a healthy interest coverage ratio of over 5, which suggests that the company is in a strong position to meet its interest obligations. HCA's return on invested capital sits at 14.9, indicating that the company is effectively using its capital to generate profits. This, along with its operating margin of nearly 15, shows that HCA is highly efficient in its operations. The company's gross profit margin is just over 40%, which is solid for the healthcare industry. Additionally, HCA generates over $70 billion in revenue annually, with profits of $6 billion in the last 12 months. Its free cash flow is another standout, coming in at $5.6 billion, showing that HCA has ample cash after covering capital expenditures. Now let's shift gears and take a look at Universal Health Services. UHS, while smaller than HCA, still holds a significant place in the healthcare industry with a market cap of around 12 billion. UHS operates more than 400 healthcare facilities in the US and the UK. Like HCA, UHS also trades at a reasonable valuation with a forward PE of 10.37, which suggests it's trading at a slight discount compared to its expected future earnings. One notable strength of UHS is its balance sheet. The company has a lower debt burden than HCA, with a debt to equity ratio of 0.76. UHS also has a healthy interest coverage ratio of 7.66, which means it's even better positioned than HCA to handle its debt obligations. The company's current ratio of 1.39 also shows that UHS has more than enough liquidity to cover its short-term liabilities. In terms of profitability, UHS has a return on equity of 16.3, which, while nowhere near HCA's figure, is still respectable. Its return on invested capital is also solid at 8.27%, and the company's profit margin is 6.7%. UHS brought in 15 billion in revenue over the past year, with a net income of a little over 1 billion. The company's free cash flow of 957 million is another positive sign, as it shows UHS has plenty of cash available after covering its operational expenses. From a dividend perspective, both companies offer a modest yield. HCA's dividend yield is 0.91, paying out around $3 annually per share, while UHS pays a smaller dividend of 80 cents per share, yielding 0.44. Neither stock is particularly attractive for income focused investors, but they both have room for growth in dividends as their earnings and cash flows continue to increase. When we look at analyst sentiment, both companies have a consensus buy rating. HCA's price target is offering over 20% upside from current levels. UHS, on the other hand, has a price target with around 23% upside from its current price. Both stocks present attractive opportunities for long term investors, especially those looking to add exposure to the healthcare sector. So, HCA and UHS are both strong companies with solid growth prospects and relatively attractive valuations. HCA is the larger player with stronger profitability metrics, while UHS offers a cleaner balance sheet and lower debt levels. Whether you're looking for more growth potential or stronger financial stability, both companies have something to offer. Thanks for watching, and don't forget to like and subscribe for more videos. Keep up with your financial education. Enjoy.
We grew